Hey, good afternoon, everybody. It's Greg here, and I'm with Dan, and I wanted to have a conversation with him for your benefit about a trade that we had put on some time ago that did the exact opposite of what we believed it would do, and to show you and explain how this was managed to actually turn it into a profit from what could have been obviously a loss, since it didn't work out. And it did, as I said, not only the opposite of what we had expected, it did it in a dramatic way, which makes it even that much more interesting, and to follow along how Dan actually managed this to turn it into a profitable trade, which is incredible. And the power of options and how they're used by someone who's an expert. So with that being said, let's bring Dan on. And so Dan, when we discussed this and we looked at this play, just mark off here. This is what we were looking at the time as prices were clearing this support area here, and we had what looked like a little downside shakeout, and prices were breaking out. And even though the 200 was up here, it certainly looked like it was going higher up into this area up there. And as I mentioned, that is not what happened. So, rather it went sideways, and all of this looked great. And then on the earnings, it gapped down and went, and that's where, okay, how do we deal with disaster mode here? What was the play, and how did we do that? How did you do that, I should say?
All right, thanks, Greg, and hello, fellow traders. We entered this as a breakout play, and we knew earnings were coming up, so we did not want to take a directional trade. And Greg and I tried to broadly categorize our two types of option trades. One is directional, when we're expecting a big move in the stock pattern, and therefore we might do a bull call spread, buy a call, buy the stock, etc. When we are just calling a short-term bottom or top and the premiums are escalated, we love selling premium because the odds are stacked in your favor. We have over 90% batting average on selling credit spreads, where we get paid on the time decay day by day, with the goal being that the spread expires worthless and we keep the premium received as pure profit. So on this particular pattern, wide range bar breakout from what appeared to be a reverse head and shoulder looking pattern, and we were just calling a short-term bottom. So with the spiked volatility, that gave us some good premiums to sell. On October 19th, we recommended and put an alert out to our traders. We suggested selling the November 35 put for 58 cents a share, and we track everything on 10 lots, which represents 1,000 shares of the stock. And we're obviously looking at First Solar here, symbol Foxtrot Sierra Lima Romeo. So we took in $580 on October 19th that went into our trading account. Then, as Greg said, on earnings, the stock gapped down and had a very ugly sell-off. So we were in management mode at that time. Greg was asking me, well, what were the options to get out of it as it's going against us? You could take your stop. You could try to implement more bearish strategies to counter-react the bullish position we had on here. But the problem with just closing this position out was that in the heat of the battle, or heat of the hurricane, if you will, the market maker further spikes the premiums. So if we took, and in addition, the spreads widen tremendously. So trying to get out of this as the stock is tanking for 2 days would have been extremely difficult. And if you did get out, it wouldn't be at a favorable price at all. So you would have suffered a huge, huge loss in closing that position. So we sat through a little bit of pain. We watched it. We're in trade management mode. So we let the stock get assigned to us at the $35 strike price.
Dan, so for people that may not know what that means, the stock was assigned to us, meaning we had to buy it.
Absolutely. We were short a 10 lot of the $35 puts. What does that mean? That we took in $580 for the obligation to buy 1,000 shares of First Solar on or before the third Friday of November at $35 a share. If the stock is trading below $35 a share at expiration, then the person who purchased this $35 put is going to require that we get our checkbook out and pay $35 a share in exchange for the contract we entered into. So 1,000 shares of First Solar ended up in our trading account, and we had to pay $35,000 for those shares. So what we did at that point in time is we sold a 10 lot of the December $32.50 calls. We took in $1,700. So that lowered our cost basis from the $35 a share to a little bit under $33 a share.
So Dan, just so, again, for our listeners that do not have the expertise as you do, we, at that point, the thinking was, this isn't going back up. So the 32 and a halves were sold.
Exactly
And the
correct.
mindset, it's not going up there, so let's take in some of this money now that this is going against us. It's not going back up based on the pattern.
That's exactly correct, that we wanted to take in some premium to lower our cost basis in exchange for giving up any upside move in the stock over 32.5. But based on the chart pattern, we didn't think there was a high likelihood of that, so the risk to reward of taking in $1,700 far outweighed the risk of giving up any upside, particularly as this stock, when it gets devastated like this, I kind of think of it like it's going to be in intensive care for a while. It needs to heal. So that's a great opportunity for us to sell premium while it's in the emergency room healing.
So just so you all know, well, why is this going to be in intensive care? So just from a technical point of view, meaning the technicals that we use to interpret a chart, well, this big red bar on this volume is what we call an igniting bar. So it ignited to the downside after a consolidation. It's a very bearish pattern, and that suggested it would go lower, and for that reason, our belief that it's not going back up, taking the $1,700, it's not going to go back up within the amount of time that that option is going to expire.
Okay, so our current position now is we have a covered call. We are long 1,000 shares of First Solar, and we are short a 10 lot of the December 32.5 calls. What does that actually mean, we're short the 32.5 calls? It means that in exchange for that $1,700 that went into our pocket or trading account, if you will, we are giving the call buyer the right, but not the obligation, to take our 1,000 shares of First Solar from us on or before the third Friday of December at $32.50 a share, which is called the strike price. So that's where we are right now. We have, I'm sorry, not today, but in our story, we have a 1,000 lot covered call on First Solar. Our next move, Greg, show them this bar. This wide range breakout bar, which was on December 16th, we thought the stock was coming out of intensive care and started to act more bullish with that wide range bar break above prior consolidation, making a higher high. So we did not want to cap our gains at the $32.50 strike price. So we did what we call rolled them higher. So we bought back the 32.5 calls, and we simultaneously sold the $37.5 calls for the next month, for January. And we did that at what's called a net credit. We're buying to close the 32.5, we're selling to open the Jan 37.5, and we received 85 cents a share. On our 1,000 lot covered call, that equates to $850. So this now lowers our cumulative cost basis to $31.87 a share. Now recall, we had to buy this stock at $35 a share. But so far in the story, our cost basis is $31.87 a share. So we continue through time, we're in trade management, we watch our positions every day, and then over the weekend, when we were writing the letter for you all, our viewers and traders and subscribers, we noticed that it's in a big, narrow, neutral manner, and actually a slightly on the bearish side. Now, our position of the covered call, long 1,000 shares, short the 10 lot of the 37.5, gave us a delta, which I'll explain, of 880 shares. Now, if you were long just 1,000 shares of First Solar, then you have a delta of 1,000, because for stock, one share is one delta. But when you're dealing with options, the delta tells you how much the option price should move with a $1 move in the stock. So being short the 10 lot of the 37.5, that reduced our 1,000 delta down to 880. Now, Greg and I were looking at our open positions, and we didn't want to be short 880 deltas of First Solar, so we wanted to put on a trade to make it a little bit less bullish, to reduce those deltas. So what we recommended was adding to our covered call a bear call spread. What does that do? It lowers our deltas, and we bring in more premium to lower our cost basis. So we recommended selling the January $35 call. And Greg, can you show them the reason? You know, we picked $35 call over support, since we're in a range-bound consolidation, and we brought in extra premium. We didn't want to be naked short that call, because then you have unlimited liability. So we bought a protective $39 call just as an insurance policy. So that further lowered our delta to under 800. So what did we do? We brought in another $400, we lowered our delta, and we're fine with the position. As we are reviewing the numbers currently, the stock's at $33.55, and I was looking at the math to just close the position or give different stops depending on your individual trade management. So we're going to conclude this with giving you a few options. You can actually close the entire position right now, close the covered call, close the bear call spread, and based on our cost basis of $31.47, you still would be closing this at a $1,600 gain right now. Alternatively, you could put a tight stop under $33 to close the covered call, and if you wanted to close the bear call spread over $34, that's a very tight spread where you would take advantage of the remaining position, whatever side First Solar decides to break up or down.
Just as a side note, what if this just keeps going sideways here and between 33 and a half-ish and 34 and a half or so, what's going to happen with these options?
Sure, then our position is totally fine. The reason for that is because we're still have a long position, but we are short premium, which is what we're experts at. So every day that goes by, provided it doesn't take our stop out, we are making money every single day with time decay on our short options. And the next option expiration for January is a week from this Friday. So if it did that for the next 9 days, then we would decide at that point in time, are we bullish, bearish, or neutral? And that would determine whether we stayed in the trade, for example, and then sold the February calls against it, taking in premium to further reduce our cost basis, or I would have to tell you at that time. But that's the beauty of the option market being three-dimensional. You can put on different trades that are not available just trading stock alone.
And this right now, as I see it, is a coin flip as to which way it's going to go. And it's getting tighter. So, my preference and vote, talking to Dan before he came on, is like, let's just close it out and take the money.
16, and think about this, folks. We entered this position taking in $580 when the stock was breaking out over $40. So at $33.50 or so, where the stock's trading right now, the stock went $6.50 against us from entry to our talk right now live, and we are still $1,600 profitable with the use of these option strategies that we've been recommending.
And there's no way possible, unless you just took your lumps if you were long the stock and then went short the stock, to have turned that into a profitable position.
It's absolutely correct.
All right, with that being said, I hope you all enjoyed this lesson. There was a lot of terminology and explanation that Dan provided with that. And if some of it or all of it was over your head, well, that is part of the learning process. And, with anything, there are things to learn in becoming an expert at utilizing these strategies in this way. But I thought this was a great example of a trade setup that did the totally unexpected from what the pattern had suggested at the moment. And Dan's management of this was just awesome, to been able to turn this into a profit at this time. So with that being said, hope you enjoyed it. If you have any questions, especially on the options side here, email dan@mastertrader.com. And of course, you could always email me, greg@mastertrader.com. Have a great day.
Thank you.